This video lesson is going to continue what we are learning about the government and the economy. So a quick little recap. We looked at the economy has its ups and its downs, that supply and demand drive the market, as well as spending, the amount of loans that are available, and we talked about recessions and depressions. We profiled very briefly the Federal Reserve and look at some of the key aspects of what the Federal Reserve does in terms of trying to bring stability as well as growth to the marketplace. We went over the reserve rate, which is the amount of money that banks keep in reserve, which impacts the amount of money that banks can loan out. We also talked about the discount rate, aka the interest rate, which is the percentage of the loan that must be paid back to the Fed by the bank, but also by you to the bank. The next big question we need to answer is, how does the Fed impact the economy? So what actions can the Federal Reserve take in order to maintain that stability in the economy and promote growth? So we talked a little bit about inflation in class, so let's go back over that. Inflation is a rise in the cost of goods and services as well as a decrease in the value of your currency. Too much economic growth will lead to inflation. Our scenario here takes the price of a Snickers bar from $1 in 2010 to $1.10 in 2012. The Snickers bar didn't change, but the price sure did. So due to this rapid growth in the economy, with lots of spending and lots of borrowing, we have inflation, which devalues our currency was definitely not a good thing. So inflation is natural over time, but in this scenario, with a 2-year difference between the 2010 Snickers bar and the 2012 Snickers bar, we're seeing some serious inflation. So what can the Fed do to reverse inflation and maybe slow down the economy and bring prices back down? They can do two things, and we're going to put these under what's called contractionary policy. So the first thing that the Federal Reserve could do is they could raise the reserve rate on the banks, requiring the banks to have more money in reserve, making it more difficult for the banks to loan money, thereby reducing the amount of money in circulation and the amount of money going out into the economy. That's not something they do very often. But what they usually do is raise the discount rate, charging banks a higher rate to repay the money that's been borrowed. And remember, the banks pass that discount rate on to the consumers by raising interest rates on loans. A higher percentage in rates means fewer people and companies are going to borrow and spend that money. This is going to lead to a drop in demand and therefore a drop in prices. So this is called contractionary policy. The idea here is to contract the economy, to take money out of circulation, to take money out of the economy and bring the economy back down. So during low interest rates, borrowing and spending is high. I go out and buy that new house, that new car, I take the family to Disney World, and the economy goes up and up and up, but that leads to inflation. When the Fed raises the rates, then the economy is going to start heading back down, because with high interest rates, there's going to be less borrowing. We might put off buying that second car. We might put off taking another trip. We're going to save our money. We're not going to borrow as much or use as many credit cards because the interest rates are higher. By raising the rate, the economy should go down, the trend should reverse itself, and prices should come back down to normal because of a decrease in spending. So then let's say the reverse is true, that we find ourselves in the middle of a recession when the economy goes down, or a depression when the economy goes down over an extended period of time, like the Great Depression from 1929 to about 1941-42. Well, what happens in a recession or depression? It's the production of goods decrease significantly. Lack of spending will impact demand. A lack of demand for products and goods will impact production. The only thing that goes up during a recession or depression is unemployment, because we no longer need those people working. Banks stop loaning money and businesses cut spending. So this is not a good thing either. So just like the opposite of inflation, the Federal Reserve needs to do something in order to jumpstart the economy. This is called expansionary policy. What we want to do is we want to expand the economy. We want to put more money out in circulation. So what we can do is the opposite of what we did during inflation. During expansionary policy, the Federal Reserve could lower the reserve rate, putting more money into the banks. therefore letting the banks loan out more money into the economy to try to jumpstart the economy and get it going again. The Federal Reserve could also lower the discount rate. Let's say it was raised to 12.5%. We're going to lower it back down to 6.5%. This lower rate will allow more people to take out loans and therefore spend more. So contractionary policy is taking money out of the economy. Expansionary policy is putting money into the economy to get it going again. So as our red line indicates our economy going down, the Federal Reserve will decrease the rates, and then the economy will start to drive back up. We'll begin to see more construction, automobile manufacturing, more jobs, and more wealth being created. This should reverse the trend and bring the economy back up. So to sort of recap, expansionary policy is what you want to do to drive the economy up. So our upward arrow is what we want. To do that, we're going to institute an expansionary policy, which puts more money into the economy and helps drive it back up. But if we need the economy to go down with our red arrow, we're going to practice contractionary policy, which puts less money into the economy and reduces the overall money available, slowing down the economy and putting it in a downward trend. And of course, my very famous thumb technique to remember how these things work. So if your left thumb is the economy and you put your thumb down, well then your right thumb is what you're going to do to fix the problem. So if we want to make the economy go down, your left thumb is down, your right thumb goes up. If we want the economy to go down, you raise the reserve and discount rates. If your left thumb is the economy and your thumb is up, that means you want to make the economy go up, so you lower the reserve and discount rates, your thumb goes down. Very famous thumb technique. Last thing we're going to wrap up with is the government's role in this, because the government spends and taxes as well. So very much like the Federal Reserve, the government impacts the economy in a number of ways. And that's called our fiscal policy. These are the government decisions on taxing and spending that are intended to improve or maintain the economy. And in terms of government spending, there are two different types that we need to be aware of. Mandatory spending are the programs whose funding is fixed, and they must spend money on these programs, a specific amount of money. Most of this falls under Social Security, Medicare, and Medicaid. And then there's also discretionary spending. This is money spent on programs whose funding changes year to year and depending on the administration. Well, the government can also take actions to help reduce inflation or to help pull the economy up out of a recession. So in terms of inflation, if the economy is going a little bit out of control, could the government take actions to do that, to reverse that trend and reduce spending? Absolutely. So what the government could do potentially is to raise taxes, which is never popular. But by raising taxes, they would impact people's spending ability. If my paycheck all of a sudden got a lot smaller, I wouldn't be spending as much money or borrowing as much money. And the government could also reduce spending through its discretionary programs. So they could cancel government contracts or reduce spending in certain areas. This raising of taxes or reducing spending would reduce the money in circulation and therefore be contractionary. If we are in the middle of a recession, one way that the government could impact the economy is to lower taxes, again, putting more money in the hands of Americans by reducing the taxes on their paychecks. The government could also help get us out of a recession by increasing government spending on programs and maybe works projects. This is expansionary because it increases the money in the economy and hopefully will drive the economy back up. Cute little chart here just to kind of show you some mandatory and discretionary spending areas and how they compare to each other. If you want to pause the video and take a little bit deeper dive, here are some discretionary spendings from 2016. You can see that defense makes up nearly 50% of our discretionary spending. And here are some examples from 2016 of mandatory spending and the cost for things like Social Security, healthcare, and income security. So to wrap it up, what we need to do is understand the role of the Federal Reserve as well as the government and how it impacts our economy and which actions the government and the Federal Reserve could take to make the economy go up or make the economy go down. These are things that you're going to need to be able to apply to questions on the graduation test. So hopefully this video lesson helped you figure those out.